So 10-year, 1.675, and obviously equities doing what they're doing at the open. Let's get to Bob Pisani. Hey, Bob.
Good morning, guys. Happy Friday. This is a very modest reaction to a hotter PPI. Remember what happened to stocks in February, particularly tech stocks, really got slammed on concerns about higher inflation, higher rates. That's not happening really today. Many traders feel that worrying about inflation is not a big money-making move right now. Now, let's take a look at the sectors. Now, you'd think on a day like today, rates up. Oh, so the reflation trade, the banks would do better, energy would do better, industrials would do better, and tech would be down in a notable way. Well, tech's down, but not much at all. It's a very, very modest reaction. Just take a look at some of the mega cap tech names here today, and you can see, I mean, all of them started fractionally to the downside, the Apples and the Microsofts and the Avagos of the world, the KLA 10 core, all weaker. But this is a pretty modest reaction to a rise in rates and what's perceived to be hotter inflation numbers. High growth stocks as well, Cathie Wood stocks, whatever you want to call them, also started to the downside. But again, fairly modest reaction in the overall markets to these stocks. Again, they had a nice run in the later part of this week here. Meantime, big start to earnings next week. On the 14th with JPMorgan will be starting. And these are quite strong numbers here. These are big changes from January. First quarter numbers expect to be up 24%. Second quarter numbers up 54%. Again, these numbers have been going up for the past couple of months. There's a couple of big issues, including what we saw today, that's going to hit. Number one, of course, is concerns about higher rates and higher inflations. And that is already starting to come through in terms of concerns about lower margins due to higher costs. We have already seen Kimberly-Clark and Smucker raise prices on higher costs. So food companies have already been reporting some higher costs. The question is, of course, is this transitory? Finally, a great question, Carl, to discuss here is last year we didn't get much guidance. This year they're expecting a lot more guidance. But some people are saying, you know, CEOs ought to seize the opportunity to specifically provide less numeric guidance. This has been debated for years, Carl. A lot of CEOs don't like being pinned down like this. And a lot are saying maybe this is an opportunity to reset the expectations around guidance.
Shepard Smith here. Thanks for watching CNBC on YouTube.